Well, if you're an investor and you're watching this and you're worried about how well China is expected to do, worry not, because what we can do is, as an Indian investor, you can actually opportunistically invest in Chinese and Hong Kong equities and take advantage of the rally that's expected in those markets. Remember, diversification on your portfolio is key. So while there is a home market bias with Indian equities, what you want to do is you can allocate maybe 5 to 10% of your portfolio to Chinese and Hong Kong stocks, which are currently red hot. The way you can do it is invest in mutual funds, which invest in these Chinese funds, or you can do it through exchange-traded funds. Now, let me walk you through the various products that are available for you to fulfill this objective. First up, a very popular mutual fund that's available for retail investors is the Edelweiss Greater China Equity Offshore. This fund invests in Greater China. As the name suggests, it invests in markets like China, Hong Kong, and Taiwan. The way it does so is by investing in the JP Morgan fund, Greater China JP Morgan fund. The returns of the fund have also been pretty impressive. In the last 1 month, it's up 2.7%. In the last 3 months, it's done returns of nearly 14%. And over the last 1 year, the returns have been close to 21%. All this at a time when those markets have underperformed the rest of the world. The other way to do this is to invest through an ETF, which is an exchange-traded fund. ETFs, by the nature of themselves, are low cost. The Nippon India Hansing Bees is a very popular ETF that's been used by investors to invest in the Hong Kong market. The returns of this fund are 1 month 1%, 3 months it's done 3%, and over the last 1 year, the returns it's done is about 22.4%. Because it's an ETF, all it does is it tracks the performance of the Hong Kong index, which is the Hansing. The other ways that you can invest into the Chinese and Hong Kong markets is by doing it through a global fund. The ICICI Prudential Global Advantage Fund is another popular fund. This is a fund of fund, and it invests in emerging markets, including China, not only China. The returns again of this fund have been good. Over the last 1 month, it's done about 1.5%. And over the last 1 year, the returns are 25.5%. What you want to keep in mind is that this is not only China focused, but it is focused on emerging market as a pack. The other popular one that a lot of investors are considering or have invested in is the Mirai Asset NYSE FANG Plus ETF. Again, what this one does is invest in a lot of the tech companies in the US. It also invests a small part of its corpus into Chinese tech companies like Alibaba, Baidu, and Tencent. The returns here have been phenomenal over the last 1 year. It's up about 54%. Here, the returns have largely come because of how well some of those stocks in the US have performed. Along with that, those are, of course, mutual funds and ETFs. There are other ways an investor can invest in China and Hong Kong. This route is more direct in nature. So if you have an understanding about Chinese and Hong Kong or Taiwan equities, what you can do is open an account with a broker, a foreign broker, usually like the ones that we are more commonly known as, like the IB or even Zerodha, for example, can help you open this account. And what they can do is then you can identify the stocks you like in China and make those investments specifically. The other way that you can do it, which is a rather indirect route, is to buy Chinese stocks that are listed on the NYSE. Again, this can be done through an online brokerage firm. So those are the many ways in which you can take advantage of the rally that China and Hong Kong is about to witness. But there are lots of things you want to keep in mind. Firstly, diversification is critical. So do not put all your eggs in the Chinese and Hong Kong index, because one being, you want to diversify your portfolio. Second, these funds also come with high risk. Also, what you want to keep in mind, expense ratio. So the cost of investing is quite high. Of course, that rule doesn't apply to ETFs. For a fund of fund, the cost of investing is quite high. And also what you want to remember is that there is no home bias, which means that you may not be completely aware of what is happening in these markets because you're sitting in India and making these investments. So you should talk to your advisor and then decide how much and which fund you should invest in if you want to take exposure on the Chinese and Hong Kong market. So all in all, don't be sad, don't be disappointed if the Indian markets may go through consolidation and the expectation is that China and Hong Kong are going to do well. There are more ways than one that you can actually make good and make investments in those markets.